Perfect. Let's talk about something nobody puts on Instagram under sunset photos. Europe 2026. Tax traps for expats. You see the cappuccino. You see the coastline. You see the €1 house in Italy. What you don't see is the tax letter arriving 18 months later. Today, we're breaking down the real traps expats fall into in Europe in 2026. Not theory, not influencer dreams, structural stuff. The kind that quietly eats your cash flow while you're posting about slow living. Let's start with the first illusion. Tax residency is not where you feel happy. It's where governments feel you owe them money. Most people think, I stay under 183 days. I'm safe. Not necessarily. In many European countries, tax residency can be triggered by center of vital interests, family location, permanent home availability, economic ties. Spain, France, Italy, Germany, Portugal. They don't only count days, they count gravity. If your life pulls toward that country, they may pull your tax file toward it too. And here's where it gets interesting. In 2026, tax authorities share more data than ever. CRS automatic exchange of financial information is not new, but enforcement is more algorithmic now. Your bank accounts talk, your brokerage talks, your crypto exchanges increasingly talk. The era of they'll never know is fading. Second trap, worldwide taxation. Many expats assume they'll only pay tax on local income. Wrong in most cases. Once you're tax resident in a European country, you're typically taxed on worldwide income, dividends from the US, rental income from another EU state, capital gains from your brokerage account, even certain crypto disposals. And this becomes brutal if you don't understand how double taxation treaties actually work. Because a treaty doesn't mean you pay nothing. It means you avoid paying twice in full. Sometimes, credits, exemptions, timing differences, mismatched classifications, these details matter. If one country treats something as capital gain and another treats it as business income, you can get stuck in gray zones. Third trap, exit taxes. This one surprises digital entrepreneurs the most. Countries like Germany, France, Spain, and others may apply exit tax when you move away, especially if you own shares in a company or hold significant business assets. Translation: you leave. They calculate hypothetical capital gains. They tax you as if you sold, even if you didn't sell. In 2026, this is more relevant than ever because remote founders move more frequently. You can build from anywhere, but governments don't like mobile tax bases. If you built a company in one country and then relocate, check exit tax rules before you book that one-way ticket. Fourth trap, special tax regimes that expire. Portugal had the famous NHR regime. Italy has flat tax options. Spain has the Beckham Law. Greece offers lump sum systems. Malta has residency structures. But here's the pattern. Governments introduce attractive regimes to pull talent and capital. Then political pressure rises. Then rules tighten. In 2026, several regimes have been modified, restricted, or politically debated. Expats who moved under one set of assumptions sometimes face renewals under different conditions. Always ask, how long is this regime guaranteed? Is it written into law with sunset clauses? What happens after the 5 or 10-year period ends? Because lifestyle migration without a long-term tax map is just expensive tourism. Fifth trap, Social Security. People obsess about income tax rates and forget social contributions. In some European countries, social charges can add 20 to 35% on top of income tax. Freelancer in France? Autonomo in Spain? Self-employed in Germany? Your effective burden can be very different from headline tax rates. And coordination rules across EU states are complex. If you work remotely for a foreign company but reside in another EU country, determining where you owe social contributions can get technical fast. Sixth trap, Permanent establishment risk. Digital nomads running companies often think, my company is registered in Estonia or the UK. I'm fine. Not always. If you manage and control the company from another country, tax authorities may argue that the company has a permanent establishment where you physically operate. That can trigger corporate tax locally. Yes, even if your company is legally registered somewhere else. This is becoming more relevant in 2026 as remote founders spend longer periods in one place. Seventh trap: wealth taxes and property taxes. Some European countries apply wealth taxes. Others apply significant property taxes or transfer taxes. Buying real estate in Southern Europe sounds romantic. But check. Annual property tax. Wealth tax thresholds. Inheritance tax rules. Capital gains tax on resale. In some countries, inheritance tax applies based on residency of the heir, not just location of the property. That Mediterranean house may come with a Mediterranean inheritance bill. Eighth trap: crypto assumptions. Crypto taxation across Europe is not harmonized. Germany historically offered tax-free crypto gains after 1 year. Portugal used to be very lenient. Other countries tax crypto like financial assets. But rules evolve. In 2026, many countries have clearer reporting frameworks and enhanced exchange cooperation. Some apply progressive income tax to short-term gains. Others treat staking and DeFi income differently. If you're crypto active and relocating, tax classification can change your entire strategy. And this is where planning beats improvisation. Ninth trap: banking and substance requirements. Opening bank accounts as a new resident can be slow. Anti-money laundering rules are stricter. Source of funds documentation matters more. If your income structure is complex, crypto, online businesses, foreign dividends, expect questions. And if you're trying to use low-tax structures without real substance, authorities increasingly look at where value is created. The theme of 2026 is substance. Governments care less about your passport and more about where you actually live, work, decide, and consume. Now let's zoom out for a second. Why is this happening? Europe faces demographic pressure, aging populations, high public debt, energy transitions, defense spending increases. Governments need revenue stability. Mobile high earners are attractive, but also politically sensitive. So the system is tightening, but not uniformly. Some countries still compete for talent. Others prioritize fiscal consolidation. The key is not fear. It's alignment. If you're considering moving to Europe, think in layers. Layer 1, residency rules. Layer 2, income tax and social contributions. Layer 3, corporate and permanent establishment risk. Layer 4, long-term regime stability. Layer 5, exit scenarios. Because leaving can be more expensive than entering. And here's something practical. Before relocating, simulate 3 scenarios. Best case tax year. Average year. High income year. Look at effective tax rate, not nominal rate. Also calculate healthcare contributions, pension obligations, accounting and compliance costs. Sometimes the low-tax country becomes average after you include everything. And sometimes the high-tax country becomes acceptable because of stability, infrastructure, and predictability. Europe is not one tax system, it's a mosaic. Italy is not Germany. Portugal is not France. Spain is not the Netherlands. And within countries, regional taxes matter too. For example, inheritance tax differs between Spanish regions. Wealth tax rules vary. Municipal property taxes differ. The details are local. The consequences are global. Now, let's talk mindset. If you move purely for tax optimization, you may end up frustrated. If you move purely for lifestyle and ignore taxes, you may end up surprised. The sweet spot is strategic lifestyle design. Choose a country where you're comfortable building substance. You can legally align your income structure. You're ready for compliance. Because compliance in Europe is paperwork heavy. Digitalized? Yes, but still structured. And one more thing. Don't copy someone else's plan from 2021 or 2022. Tax regimes evolve fast. What worked for a YouTuber 3 years ago may not work in 2026. Always verify current law. Always check treaty details. Always consider exit tax before entry tax. Almost Expat is not about escaping systems. It's about understanding them before you relocate your life. Europe in 2026 is not closing its doors. It's professionalizing them. If you plan properly, you can still build a life with sunshine, walkable cities, culture, healthcare, and stability. Just don't let the tax office be your unexpected roommate. If you're thinking about changing your country, redesigning your income, or building a life somewhere between sea breeze and structured compliance, this channel is for you. Because moving countries is not just geography, it's architecture, financial, legal, and personal. And if you want to redesign your life and actually enjoy the freedom you're chasing in another country, subscribe to Almost Expat. Now tell me honestly, if you could choose one European country tomorrow, but you had to accept its full tax system without complaints, which one would you pick? Until next time, arrivederci, amici.